Bit of good news now in the form of the GDP numbers, which were released by Statistics South Africa at 11:30 this morning. Essentially what's happened is that the economic growth in this country has quickened to 3% quarter on quarter. OK, the market was expecting 3.3, but we'll take 3%. It's around about the best for a year. And that was and we've also gone to year on year 1.2% rather than the 1.9% forecast. Let's get into the numbers now and see what's driving them with Busisiwe Radebe, who is an economist at Nedbank Capital. Busisiwe, a bit of good news, a stabilisation, I think.
Lindsay, if you look at that number, just based on base effects, we had that growth of only 0.9% in the first quarter, which totally shocked the market because I think they were expecting something like 2.1%. So just on base effect, coming off that low base, that 3% that we saw in the second quarter was exactly what the market actually expected. So from a low base effect, that is it. But if you look at that number just in detail and what actually drove it, the first thing is the manufacturing sector, which accounted for about 1.7 percentage points of that 3%. There, the main thing there was the basic iron and steel category. And we kept on seeing that coming through in manufacturing. That's what actually, the manufacturing numbers we've been seeing, a big role there was played by that particular division. I think there were supply concerns and one of the furnaces at one of the huge factories actually had an issue there, and that came back online in the second quarter, and that's why we're seeing that big jump. I think manufacturing, value added by the manufacturing sector, was actually improved to about 11.5% in the second quarter, and that was from a decline of about 7.9% in the first quarter. So it is a good figure. We've seen sort of manufacturing just play into that, and it counts for about 1.7 percentage points.
OK, yeah, so I don't think we should be too surprised about the 1.7% though, because don't forget, for the last 4 months, Busisiwe, we have been above 50 in the Purchasing Managers Index, which is, of course, an indication of the health of South Africa's manufacturing economy. What I really want to know is, though, how much do you think that the Rand has played an influence in this 1.7% contribution?
To manufacturing. So that 1% contribution to manufacturing, yeah. So we've seen this weaker Rand, and I think you've seen a few weeks ago, or it was a few days ago in one of the newspapers, where Minister Rob Davies was saying this was actually good for exporters, this weaker Rand. And it is a good thing for exporters, but we should also think of other impacts that the weaker Rand has, such as the impact that it has on inflation. So I think, yes, good for exports, but I think one of the things that we do in one of our studies that we look at Nedbank is, yes, we can look at the impact of the Rand on exports, but then we also should look at things like the impact of our infrastructure here and things like supply constraints and just getting containers out of our ports. And that actually has a bigger influence than actually trying to mess with the Rand, or at the moment the Rand is weakening for all sorts of other reasons, not intervention from us. But I think an important aspect is actually to look at infrastructure. Are we able to actually cheaper and more efficiently and quicker get out containers to actually export goods and things like that? And I think that plays a more important role than actually trying to sort of weaken a currency or this particular weak currency, because you must remember the weak currency also has other ramifications, and inflation is actually one of them.
Yes, it is, and we saw 6.3% CPI, and that looks as though with the Rand at 10.40 currently, that in months to come it might even get worse than that. Let's move to the services side. The contribution, for example, from finance, real estate and business services, which was 0.8%. Any comment on that, or is that expected?
That was also expected. I mean, if we look at all the numbers in general, Lindsay, now, besides that 11.5% value added we saw for manufacturing, if I look at all the other numbers, and maybe electricity and water sort of had an improvement there to 5.3%, but that's also just coming from, I think there were strikes at Medupi in the first quarter, and then we saw an improvement there. But the rest of the other numbers are still not shooting the lights out. Even finance, real estate and business services, that actually value added there only accelerated marginally to 3.5% from 3.3% in the first quarter. And if you look back, you'll remember that in 2012, that sector made up about 21.5% of GDP. So you do expect that 0.8% coming from the finance section. But I mean, if you look at that number carefully, the acceleration was not huge. It came from 3.3% in the first quarter to about 3.5% in the second quarter. But the general story here is what's going to happen in going forward, looking into the third quarter, and just what is the general picture here. The general picture is, yes, growth is still actually patchy. Value added, if we look at all the industries, I mean, if I look at something like mining, value added there was 14.6% in the first quarter. That was also just a rebound there. And I mean, that was minus 5.6% in the second quarter. If you just look at various numbers, the numbers are not shooting lights out. What's going to happen in the third quarter? I think you can't kind of expect the same improvement in the third quarter, because already you know that we had strikes in gold mining, we had strikes in motor vehicle manufacturing, so that is going to have a negative impact on what's going on in sort of the third quarter.
Because you see, we've had a base effect, and you've highlighted that, and the market was expecting 3% overall, or 3.3 actually, but let's say that they were more or less right. The base effect after the 0.9% shocker in the first quarter was one thing. As you say, third quarter is going to be crucial, fourth quarter probably even more. What's your call for annual GDP 2013?
In 2013, our forecast full-year growth is about 2.1%. I mean, that's down from the 2.5% that was recorded last year. So it is actually sort of a deceleration from what we saw in 2012.
Busisiwe, thanks very much for your time this lunchtime. That's Busisiwe Radebe, who is an economist at Nedbank.